हेलो एंड वेलकम एवरीवन, दिस इज प्रोफेसर सिद्धार्थ सुराना। आई होप यू गाइस आर डूइंग गुड और मैं तो हमेशा मस्त ही रहता हूं। वेलकम टू एपिसोड नंबर 6 ऑफ रिवीजन कम अमेंडमेंट लेक्चर्स फॉर May 22 एंड November 22 एग्जाम्स, previous year 21-22, assessment year 22-23. In the last class we finished the chunk of assessment up to chapter number 21 we have finished, that is revision. So we now go ahead next chapter number 22, where we will be discussing Income Tax Settlement Commission. I am not going to do anything because the news is Income Tax Settlement Commission stands abolished immediately on 1st February 2021, the day when the budget was announced. Sir, now what about the pending cases? Because there must be people who are there must be cases which have already been filed, people who have already made their application. The pending cases will be completed by a temporary organization called Interim Board for Settlement. So whatever are the pending cases, the IBS will close it, and then IBS responsibility also is over because it is new. I will be discussing IBS only, and if I have to teach any student of May 23, I am not going to be discussing this part at all. And apart from this, ITSC has gone, IBS has come only for a temporary period for finishing the pending cases. We will also discuss a new organization that has been constituted now, a dispute resolution committee. They have got no connection with each other, but what will happen next year, chapter number 22 will get deleted from the book, and I don't want to change the order of chapter numbers. So the dispute resolution committee chapter will replace the ITSC chapter from next year onwards. This is going and this is coming, that's the thing. And I purposely keep it here because the order of section numbers also after ITSC dispute resolution committee is done. So two parts. First, quick discussion about IBS, and then we talk about what is this. First of all, why was ITSC created? Whenever the government wanted that you come for settlement, declare your concealments, we will levy tax and interest, but we will give you immunity from penalty and prosecution. That was basically the idea why ITSC was created. But as we have decided that ITSC will now be abolished, so ITSC will get abolished, and the pending work of this settlement. What settlement? Assessee will come and declare all the concealments done, tax and interest will be levied, penalty and prosecution will be waived. All the pending work, all the powers which were with ITSC for a temporary period, all these powers we will be creating the interim board, and it will finish off the pending cases. This is just a temporary. The central government shall constitute one or more boards, and it will finish off the pending application. The board will contain 3 members, and all of them will be of the rank of CCIT. So in the MCQs I have incorporated, if you do all the MCQs of my book, no, in that all the theory will get completed. 3 members, and they will be of the rank of Chief Commissioner. If there is a difference in opinion, as the ITAT also does, majority decision will be taken. What is pending application? Any application that you had filed with ITSC, it was not declared invalid, means it was a valid application and order was not passed up to 31st January on the date when ITSC was abolished. Now the matter will be continued and completed by the interim board for settlement. Once all the pending cases are over, we will say Tata bye bye. Tata, Rahul Gandhi. Tata, bye bye, Khatam, Gaya. What are the points to be noted? The procedure of interim board shall be exactly same as ITSC. So whatever was the system, absolutely will be same. CBDT shall allot the pending application to the board, or it can transfer. There will be multiple boards, so it can allot the case and it can transfer from one interim board to the other. The date on which application is allotted will be treated on the date on which assessee makes application. See, once assessee makes application, the procedure as ITSC used to start. So we will treat this application date as the date of this allotment date as the date of application made by the assessee. The time limit and all that will be taken care of. The IBS will also be having a T scheme. It will also become faceless, and all powers available to ITSC shall be given to the interim board. Only one thing that you should note, and this is very important to note, that when we were making an application to the ITSC, there was a rule that application once made cannot be withdrawn. Once made cannot be withdrawn. At AAR we are allowed to withdraw, but at ITSC we are not allowed to withdraw. But now we say the assessee will have an option to withdraw within 3 months from the date of commencement of Finance Act, and you have to intimate. So you actually can withdraw your pending application. Where the assessee exercises the option to withdraw the application, the proceeding with respect to application shall abate. That means IBS will not continue. See, ITSC I was interested. Think about it as an assessee. ITSC I was interested. So I made an application, but ITSC is abolished, and now they are telling me that IBS will handle. No sir, I don't want to go to IBS. So no problem. You can withdraw your case and all the time limits accordingly will be adjusted. Whatever declarations you had made in the application to ITSC, the IT authority shall not be entitled to use it. But if the material was collected by the AO by doing inquiry, then he will be allowed to use it. So your declarations at ITSC will not be used for anything under income tax, but if they inquire and find out, then they will be allowed to do it. All pending applications to the interim board shall be allotted or transferred to one or other if they are not withdrawn within the 3-month time limit which we are giving you. And when an application is allotted to interim board, all documents and evidences shall be transferred to the interim board. So see, ITSC case information will be given to IBS, but if you are withdrawing, then that information will not be given. AO has to collect by making his own inquiry. So IBS will finish the pending cases and the topic will come to an end. Next year onwards, this thing will not find place also in our book or in our lectures. And now we have a new organization called Dispute Resolution Committee. To give you the introduction which is written here, I don't want to waste time in reading or translating from English to Hindi for North Indian students. Simply put, central government wants less disputes, less litigation, less case laws, less court cases. They want to settle dispute as easily as possible, and thus for they also provided Vivad Se Vishwas scheme is what is mentioned. Now to prevent new disputes, we are creating a new organization. Don't go in that fighting of appeal, CIT appeal, CIT. Settle your dispute. Already we have DRP for international tax assessees, but something we should give to domestic assessees also, small assessees also. We will give a new section 245 MA has been created for the purpose of dispute resolution. The government is adding an organization. The central government shall constitute one or more dispute resolution committee. It shall resolve the disputes of specified person and it will be optional. So if you don't like it, you can go to CIT appeal, CIT. This is going to be optional. Now what are the eligibility criteria? What is the criteria? Scheme will be allowed only if your income returned is up to 50 lakhs. If your income is less than or equal to 50 lakh and the variation proposed is up to rupees 10 lakh. If your income is up to 50 lakh and the addition that is being done in your income is up to 10 lakh, only small taxpayers will be eligible. Any order which is based on search or requisition or survey is not eligible. That means doubtful cases will not be eligible. Genuine cases, you show income is up to 50 lakh, variation is up to 10 lakh, you can go and approach the dispute resolution committee and they will allow you. But cases of search, requisition, survey or foreign assessees where we get information under bilateral treaties, they will not be eligible to avail this new mechanism, to avail this new option called dispute resolution committee. Further, if you have been liable or if you have been convicted under any of these other laws, so if there is detention under Conservation of Foreign Exchange and Prevention of Smuggling Act, if there is any contravention of Indian Penal Code, Unlawful Activities Prevention Act, Narcotic Drugs and Psychotropic Substances Act, Benami Transactions Act, Prevention of Corruption Act, PMLA, Money Laundering, this is there in your law portion also. If you have any prosecution of offence under these laws, then you will be ineligible. See, income tax ka immunity we are granting you. But if you are, and these are big laws, if you have done violation under these laws, then you will be disqualified. If there is any prosecution initiated by IT authority for any offence, then disqualified. Special court trial offences law under the Securities Act, then again it will be disqualified. Some other conditions may also be prescribed by CBDT and it shall have the powers to reduce, waive any penalty impossible or grant immunity from prosecution. Just like ITSC had the power, even DRC will have the power, and DRC will also function in a faceless manner by introducing a scheme of transparency, efficiency and accountability. So very simple and basic new concept of dispute resolution committee. Very simple, very basic concept. Okay. That was our chapter, Income Tax Settlement Commission and Dispute Resolution Committee. Let's go ahead. Next chapter that we have is Authority for Advance Ruling, AAR, and just like ITSC, AAR is also getting abolished and AAR will be replaced by BAR. Authority for Advance Ruling will go away and we will be having Board for Advance Ruling, BAR. I will also tell you the reason. What is this AAR? We make application for clarification of tax liability in a proposed transaction. So before doing the transaction, we will take clarification from the tax authorities as to which provision of taxation is going to be applicable to us. Why is the AAR going to stop? Actually, in the eligibility criteria to become member of AAR, the judges in AAR, You had to be High Court judge, Supreme Court judge. The eligibility criteria was very, very difficult. And it was becoming difficult to find eligible people. We did not have enough retired judges of Supreme Court or High Court who were willing to take up these responsibilities. And thus the AAR was created, but unfortunately it was not operating because there is no judge only, there is no availability of qualified people. So we are creating another organization called BAR, where the eligibility to become a judge in BAR will be very, very easy. Very easy. Somebody in the income tax hierarchy will only become eligible. And if that person is the judge, we have enough people, we can fill in the positions and functioning can start. Problem was that AAR functioning was not possible because enough judges were not available who were qualified as per the required criteria. That's the idea why AAR is abolished and BAR is created, but BAR will do exactly the same functioning as AAR. All the system of operations will be same. What AAR was doing, now BAR will do. What AAR was doing, now BAR will do. Only change being that when an order was passed by AAR, it contained High Court, Supreme Court judges. So such orders passed by AAR were non-appealable orders. You go check list of 9 non-appealable orders, you will find AAR. But BAR contains IT authority, CCIT. If an IT authority is a judge, then that order will be appealable. The only difference between AAR and BAR will be AAR orders were non-appealable, but BAR orders are going to be appealable. That's the primary difference, and all this I have explained here, that enough judges were not available, so we have this. And now whether you know AAR will be replaced now, whether you function with AAR or BAR, this is the system. Non-resident will apply for knowing own tax liability in a proposed transaction. Resident will apply for knowing tax liability of non-resident on behalf of the non-resident. Resident will apply for own liability only if he is doing transactions of 100 crores or more. Public sector company will apply in respect of cases which are pending at AO, CIT appeals or ITED. So these are the applicants and these are the questions that you can go and ask. Now see constitution of AAR. What was the constitution of AAR and why was it difficult to bring such qualified people? Chairman should be retired judge of Supreme Court, anybody who has been Chief Justice of High Court or anybody who has been High Court judge for 7 years. Vice Chairman has to be retired judge of High Court. Members have to be revenue member from Indian Legal Service or Indian Custom and Central Excise Service, or law member from Indian Legal Service. Unfortunately, these people were not available. Chairman is absent, Vice Chairman will perform his duties, that is okay. And any appointment made after this date, then this was the qualification. So earlier that was the qualification. From 2017, this will be the qualification. Chairman will be sitting or retired judge of High Court or Supreme Court. Vice Chairman will be sitting or retired judge of High Court. Slight change here. Revenue member is same. Law member is same. And who has combined period of 10 years or more, district judge he has been, or for revenue member he has performed judicial or co-judicial function for minimum 3 years. Appointment done earlier will continue to be valid, and new appointments will be as per this criteria. They also had a scheduled retirement term, a tenure. The chairman, vice chairman and members shall hold office for a term of 4 years or attaining the specified age. For chairman that age was 70 years and vice chairman and members 65 years. So 4 years or 70 years age, whichever is earlier for chairman, and 4 years or 65 years age, whichever is earlier for members. Now, unfortunately, by the time they used to retire from High Court, Supreme Court, they had already reached the age criteria and it was not possible. And that is the reason AAR functioning only was not happening. Now we create BAR, very, very simple. The central government shall create one or more board for advanced ruling under this chapter, and it will contain 2 members, each being not below CCIT. So the rank of the judges will be CCIT, and because the rank is CCIT, these orders are appealable. Here we already have Supreme Court, High Court judges, so we did not have the facility for appeal, but here it is appealable. So what is the rank of judge in the BAR? CCIT rank. Then if there is any invalid or defective constitution, by chance, it will not invalidate the ruling. Yes, this section was there. So yes, they can appoint anyone they want. But when they say anyone, they cannot pick up anyone from the road and appoint. No? There has to be some proper qualification, and thus we were not getting adequate people. That is why we took the decision of cancelling AAR and creating BAR. They could have actually changed only the eligibility criteria here instead of doing so much nonsense. They could have just made this CCIT. But then this is how auntie works. No, she does not believe in making minor changes. She has completely changed the reassessment part and search part. She has completely changed the system of assessment by making it faceless. Terrible changes are being made and year after. And now she has become more clever. Earlier, she used to announce all the amendments in the budget. So people used to say so many amendments. Now she in the budget makes only few announcements. People think, oh wow, less amendments. And then when we read the paper, we find out that so many amendments, but she did not speak about everything in the budget. Nonsense. Okay. You will have to fill up a form and pay some fees. First person, non-resident who is applying for self in form 34C. Resident who is applying for non-resident 34D. Resident of transactions of 100 crore or more 34DA. What will be the fees? Transaction up to 100 crore 2 lakh. More than 100 crore up to 300 crore 5 lakh, and more than 300 crore then 10 lakh will be your fee. So this is going to be your application filing fees. This is the fees that will be paid, but for public sector company in form 34E, we will take fees of only rupees 10,000 because that is our own company. We don't want to keep very heavy fees. Application filed can be withdrawn within 30 days. In ITSC it was not allowed, but in IBS we are allowing you within 3 months. Here it was always allowed. Within 30 days you can withdraw, and after 30 days also you can withdraw if AAR gives permission. So within 30 days my choice. After 30 days AAR will give me permission, then only I can withdraw. And this also has been tested in MCQ. Application filed at AAR can be withdrawn always, cannot be withdrawn ever, can be withdrawn only within 30 days, or fourth, can be withdrawn within 30 days as per choice and beyond 30 days after AAR permission. Fourth option will be the right option. Procedure is very simple. First you make application, then AAR will make inquiries from the CIT, and within 6 months of application they will either pass the ruling or reject after giving opportunity of being heard. Certain cases they can be rejected without opportunity of being heard. If it is a pending matter at any of the levels, then they can reject without giving opportunity of being heard. If it is a transaction of tax avoidance, that it can be rejected. If it involves computation of fair market value, that's not their job, so it will be rejected. And of course all the functions will be performed by bar. They will also operate on the basis of a T scheme. The public sector company can come only if there is a pending matter. Then wherever it is pending, they will not proceed further. The authority, wherever the case was pending, has to discontinue the case. The case will no longer be continued by the public sector company. Any ruling which is pronounced by AAR has to be binding. This is what I am continuously telling you. The rulings of BAR are appealable. AAR ruling were binding on the applicant, the department, and on the transaction, but the ruling of the BAR is going to be appealable. And how we will be allowed to appeal, for that also we have a section. We will talk about that new section, but as of now get this clear: AAR ruling is binding, BAR ruling is appealable. Section 245T, it is found that the ruling was taken by fraud or misrepresentation, then the ruling will be declared as void ab initio. They will have all the powers of civil courts, so discovery and inspection, issue of summons, production of books of accounts and documents, custody of books of accounts. All the powers that are available to IT authorities will be available to AAR, BAR also. They also have the power to regulate their own procedure. So what will be our office timing, working hours and all that, that will be decided by them only. And this is the section that I was continuously telling you. If applicant is aggrieved by an order of BAR only, then you can appeal at the High Court, directly to the High Court. No ITAT will come into picture. Directly at CIT appeals obviously cannot come because the judge in the BAR is CCIT. So CIT appeals is out of question. But ITAT also will not come. Directly at High Court within 60 days from communication of that order, and High Court can extend for maximum further 30 days, and this section appeal can be done in a faceless manner. In other words, the order passed by the BAR will be appealable directly at High Court within 60 days, and that period can be extended by maximum 30 days. That is how we are going to replace the functioning of AAR with the BAR. That was our chapter, authority for advance ruling. Very, very less important section, so only focus, I will take your focus only to the thing that matters here. This is presumptive taxation for shipping companies. Tonnage tax scheme is applicable only if you make your application, and only for Indian companies. Books of accounts you will have to be maintaining. One, because you are a company. Second, because whatever is your actual relevant shipping income as per books of accounts, that is subtracted on the less side under MAT. And third, on your incidental activities there is a limit, maximum 0.25% of turnover from main activity. Your profit from incidental activity can be maximum 0.25% of turnover from main activity, maximum that much. Okay, to give you an example, if turnover of main activity is 1 crore, then maximum allowed is 25,000. If it is within the limit, no problem. If it is more than the limit, then the excess will get added to your presumptive income. So for that, we need actual books of accounts to find out whether our incidental profit is within the limit or beyond the limit. For that purpose, we will need it. In order to get the facility of Tonnage Tax Scheme, 3 conditions: you have to be a qualifying company, Indian company having place of effective management in India. It should be operating ships which can be owned or it can be chartered, including part of a ship, and it has to be a qualifying ship. Qualifying ship means registered in India or approved by the Director General of Shipping. Capacity should be at least 15 net tons and capacity certificate should be enforced, taken from the DGS, should be enforced, but the following ships will be disqualified: any ship where main purpose is to provide land-like facilities, for example, a cruise; any fishing vessel; any factory ship; pleasure craft; harbor or ferry; any offshore installation; and any vessel which is used, which is otherwise qualified, but you use it for fishing for more than 30 days, then these vessels are going to become disqualified, not going to be eligible. Tonnage income is your presumptive income on which you will pay tax if tonnage tax scheme is opted. Relevant shipping income is your actual income. It is not taxable. If tonnage tax scheme is opted, you pay tax on this. You don't pay tax on this, but you have to calculate to check whether your incidental profit is within the limit or beyond the limit. So calculation will have to be done, and the only thing that you have to focus in this chapter is the calculation part. If you do that much, then you are prepared for this chapter. And then there is one case study based MCQ, a little theory which is not covered anywhere earlier will get covered in that case study based MCQ to prepare you for anything that is asked in tonnage tax scheme. The question will give you the tons capacity and the number of days, and accordingly you will be able to calculate the tonnage income. First, take the tons from the question and then remove the kgs. So you will be left with the ton. Take the ton to the nearest multiple of 100. Alternatively, if you want to save 3 steps, directly pick up this figure and nearest multiple of 100 is 26,900. Directly start with this. Okay, and now you apply slabs. Slabs means your tons will be divided into parts. First 1000 tons, 70 per 100, so that will be 700. Next 9000, from 1000 to 10,000, 53 per 100, so that will be 4770. Next 15,000, from 10,000 to 25,000, 42 per 100, so that will give you 6,300. And if there is anything remaining, for example, here we have 1900 remaining. After 25,000 we have 1900 remaining, so you take 29 per 100. So 1000, 10,000, 25,000 and balance 70, 53, 42, 29. 70, 53, 42, 29. This is how you will calculate. This is your income per day, and you multiply by number of days. That will give you your total income. If the excess incidental profit is more than the limit, like in the second example, this 1000 rupees, then add that also. In the first example, no need to add anything, but in the second example, you will have to add that 1000 rupees, and accordingly you will get your total taxable income. When 2 companies are running the ship in joint venture, then the net income of the ship will be divided in profit sharing ratio, but the 2 companies doing it independently, then calculate the per day income and multiply by the respective number of days. That is the meaning of joint interest and joint operation. And that's our chapter, Tonnage Tax Scheme. Not very important chapter, so we had to do it swiftly only. Next chapter, Penalties and Prosecution. Honestly speaking, the main section will be section 270A, calculation. It is very easy. It comes again and again, almost every exam. Either it will come in subjective 4 marks or it will come in MCQ, case study based MCQ for 4-5 marks. Very easy, very important. That's the main section which calculation you have to focus on. Other than that, the rest part is normal. So I'll of course briefly be telling you what is to be done, what is not to be done. What is penalty? Failure to contravention or failure for contravention of law, then you will have to pay penalty. But if there is reasonable cause, then there will be no penalty. Whenever there is reasonable cause, there will be no penalty. For example, cash loan taken, cash loan repaid, books not maintained, tax audit not done. If there is any reasonable cause which prevented you from doing that, then there will be no penalty. But these sections, under reporting, misreporting, penalty in search cases, penalty for unexplained cash credit, penalty for wrong entry or omitted entry, these are all cases of concealment. And concealment is one activity for which there can never be reasonable cause. So the facility will not be available. For any other penalty, cash loans, books not maintained, audit not done, you can show reasonable cause and escape penalty. But for these sections, there is no reasonable cause, penalty will always get attracted. Okay. Now let's go to the first and the most important section, section 270A, penalty for underreporting, which will be 50% of the underreported tax, and misreporting, which will be 200% of the underreported tax. So what will be your calculation? Step 1 will always be underreported income, which is same in both left side and right side. Step 2 will be calculation of underreported tax. The calculation is same on both. And step 3, on this you have to do half or double, 50% or 200%. If you observe carefully, this is on the same amount, underreported tax. So in other words, misreporting penalty is 4 times underreporting penalty, half or double. The calculation is very easy. Honestly, you can directly go to calculation without learning also, but very quickly. What is underreporting? Income more than basic exemption and you don't file return. That's underreporting. If you file return and we in assessment find out that the income in assessment is more than income in return, intimation, that is why intimation is compulsory. So if I show 5 lakh in intimation, if I show 5 lakh in return, it became 8 lakh in intimation. Then assessee has shown 8 lakh, return amount ignored, focus on intimation, return amount ignored. Then if scrutiny takes place and income becomes 20 lakh, that means underreporting is only of 12 lakh, not of 15 lakh. Okay. So income in assessment has to be compared with income in intimation. Every time there is subsequent assessment, every time there is reassessment, if the income in the new assessment is more than the income in the previous assessment. So for example, after 20 lakh, we do again assessment and it becomes 22 lakhs. So that means again there is underreporting. And if you file a return declaring loss, where the loss that we allow you is less than what you claim, and we will find out the loss that you claim, not from return, from intimation. Again, to give you an example, you claim in return 10 lakh loss. Because of some mistakes in intimation, it was found that only 8 lakh is eligible. Some corrections took place. That means assessee has claimed 8 lakh rupees. Return amount ignored, focus on intimation. Return amount ignored, focus on intimation. Assessee has claimed 8 lakh rupees. And now, when we did scrutiny, we find out that actual loss is only 1 lakh. That means, can I say loss in assessment is only 1 lakh, but you claimed 8 lakh. That means you claimed more loss. Or is it possible that it is a profit of 2 lakh converted into profit? That means you have claimed unnecessary loss. Whenever you claim any loss which you are not eligible, that will also be a case of underreporting. So these are the cases of underreporting. If we talk about misreporting, if you have misrepresentation or suppression of facts, that means you have not declared all the facts clearly. Income not declared or investment not declared, that means again it's a case of misreporting. You have claimed expenses without evidence, that's misreporting. Any false entry in books of account or any international transaction not reported in your 92E report, form 3 CEB, that means it's a case of misreporting, and your penalty will become 4 times. Instead of half of underreported tax, it will become 4 times of your 200%, that means 4 times of the penalty, double of your underreported tax. But the problem, if you observe carefully, is whenever they will happen, they will both happen together. If this has happened, then definitely this has happened. If this has happened, then definitely this has happened. They can always happen together. If you have done any of these things, you will definitely fall in this case, one case or the other. This cannot happen without this. That means underreporting, misreporting will always happen together. This section was created in AY 1718, and after 5 years also they have not given any clarification of when only this will happen. And thus in all the questions that institute asks, they just say, assume there is misreporting, assume there is no misreporting. Assume misreporting, like you pick up petals from a rose, say she loves me not. Assume misreporting, assume no misreporting. Assume misreporting, assume no misreporting. What do? These two you still calculate, irrespective. And for step number 3, read the question. If they say no misreporting, that means this. If they say misreporting, that means this. Be careful, because they will give you both answers in the option. You have to check whether you have to apply 50 or 200. That is how penalty is going to be levied in cases of underreporting and misreporting. This is how that calculation is going to take place. Are we all clear on this? Penalty will not be levied in the following cases. If the assessee has given an explanation and AO is satisfied about the explanation, no penalty. If the income is computed on the basis of an estimated disallowance done, intangible addition we call it, and books of accounts are correct and complete, then no penalty. He can increase tax but cannot levy penalty. if once again intangible addition is done and some expenses assessee has disallowed, there is only a difference in opinion. So assessee believes 10% personal expense, AO says 15% personal expense. So there is a difference of opinion. AO can do that estimate. Estimate is different. He can increase tax, but he cannot levy penalty. If all international transactions are reported, then no penalty. And if penalty under 271 AAB is already levied, which is the case in such cases, if that penalty is levied, then this penalty will not be levied. If that is already being levied, then this penalty will not be levied. And how will you do the calculation? When you don't file your return of income, underreported income will be assessed income minus basic exemption. Be careful. If 15 lakh is your income as per best judgment, because you did not file your RO, and I ask you what is underreported income, sir, you have not shown anything, but the answer will be 1250. For resident 60 years, 12, and for resident 80 years, 10. The amount will be the amount minus basic exemption. This is a place where you can go wrong when I do MCQs of penalty chapter. I'll show you exactly what I mean by this. And of course, how will you calculate tax? You have to calculate on the total only. So pick up this underreported income and add basic exemption. That means you are calculating tax on the assessed income of 15 lakh only. But if you are asked, the definition of underreported income is assessed income minus basic exemption. Then when your assessment takes place for the first time, your assessed income is more than the income that you have shown. And what have you shown? Not return, but intimation. Then it's underreported income, the difference. So I show 5 lakh in return, ignore. 8 lakh in intimation, take it. And 20 lakh in scrutiny. That means underreported income is 12 lakh rupees. How to calculate tax? You can't calculate tax on 12 lakh. You have to calculate tax on this and tax on this. Tax on assessed income minus tax on intimation income. Tax on 20 lakh and tax on 8 lakh. The difference will be your underreported tax. And question will tell you half or double, accordingly you will do it. Every time your subsequent, every time reassessment happens. So after 20 lakh, another assessment where 23 lakh was decided as your income. So 23 minus previous income, 20 lakh. 3 lakh is your underreported income. How will you find out tax? Not on 3 lakh. Tax on this income minus tax on this income. So tax on 23 minus tax on 20. That will give you your underreported tax, and then half or double. And in loss cases, there is no option. It's a compromise. The difference between the two figures. So if you claim 8 lakh loss and you are eligible only for 1 lakh, then 7 lakh is your underreported income. If you claim 8 lakh loss and 2 lakh is your taxable income, positive it is, then the difference is 10 lakh, that's your underreported income. There is no other logical or reasonable basis. So the difference will be taken as your underreported income, and on that underreported income directly we will calculate the tax. We will assume this as the total income and calculate tax. That will be your underreported tax. This is how calculation takes place. This table you learn very, very perfectly. Please, mainly because most times when they ask this, almost every attempt 270A in MCQ or subjective, and 4 marks they allot to this, and the question comes on this table. Even if you don't know the other things, the meaning and all, the theory, question comes on the calculation. If you learn this calculation properly, you can say you have secured 4 marks for you. So be smart, use Pareto analysis in your life, not just in costing. What are the areas that I can target and I can achieve my targets? Understood? Very good. In 270AA, we will make waiver application. Sir, please don't levy penalty. Waiver application. Sir, please don't levy penalty. If it is rejected, the rejection is non-appealable. But assessment order you can appeal. Order. Which order? Assessment order. Order of assessment you can appeal. And if the waiver application is accepted, then your assessment order is non-appealable. Then the tax is fine. So basically, waiver is granted on the understanding that you pay the tax that they decide and they don't levy penalty on you. Pay the tax that they decide and they don't levy penalty, but this facility is not available for cases of misreporting. Only cases of underreporting can make this, misreporting not allowed. And now for the other penalties which are prescribed, to be very honest, you just have to learn section non-maintenance of books of accounts, 25,000 penalty. Not getting a tax audit done, 0.5% of turnover or 1,50,000, whichever is lower. But these two will never be invoked together. Together they will not be invoked. Okay. Failure to maintain data, document, information, 2% of the value of transactions, and failure to furnish that information under section 286 miscellaneous provisions, where you have to inform whether you are the alternate reporting entity or you are not the alternate reporting entity. Only that. penalty of 5 lakh rupees. So non-maintenance of data document information 2% and non-information about whether you are the alternate reporting entity. In section 286 uniform transfer pricing documentation, this is revision lecture. Some are working only on the basis of these lectures. Bola sir, I will watch this and clear. See, halwa hai, halwa. 5 lakh rupees penalty for not informing that you are the alternate reporting entity. The data document information that you have maintained here, if you don't furnish, then 2% will be attracted, and here cumulative penalty for non-maintenance and non-furnishing will be applicable. Penalty in search cases. If your search took place up to 15 December 16, then the penalty was this much. But now, today, any search which is conducted, any concealment that you admit during search, 30% of your undisclosed income. And then if you don't admit at that time, then any other time, it will be 60% of your income. And this time it is not on tax. This time it is on your undisclosed income. Penalty under 271 AAC for unexplained cash credits, unexplained income. 78% is the tax. 78% is the tax. 60 plus 25 plus 4 under 115 BBE. And then on that, 10% penalty will get attracted. 10% penalty will get attracted on that. But if you file your return and show that income, then in that case, this penalty you can save because you have declared. So this penalty you can save. Only the tax rate will be 78% because we caught you. If you have any false or omitted entry, then 100% on that entry will be your penalty. What kind of false entry? False invoice, false evidence or sale or purchase of goods or services. So you know we make fake bills. We pass any sale purchase of goods or services without actual transaction. Accommodation entries, one person wants to show income, other wants to show expense. They give check and take cash. Such cases, or from a person who does not exist, such cases. In all these cases, any kind of dummy, especially people do this in loan transactions to give entries. I have 5 lakh check, you have cash. I give you that check, you give me cash. But we will show it as loan. Then you give me interest money, I will return in cash. Accommodation entries. Anybody doing that, 100% penalty will get invoked. Failure to furnish transfer pricing audit report, 1 lakh rupees flat penalty. TDS not deducted or deposited, 100% of the TDS amount. TCS not collected, 100% of the TCS amount. Cash loan accepted in violation, 100% of the amount. Cash loan repaid, 100% of the amount. This is section 271. DA, I'll just clear 269 ST right now only so that I don't have to waste time. In the next chapter, whenever you are receiving 2 lakh rupees or more from one person in a day in respect of single transaction or from multiple transactions related to one occasion from one person, then if it is exact 2 lakh also, you have to receive in the 3 allowable modes. If you receive in any other mode, then 100% penalty will get attracted. So 269 ST, to curb cash in the economy, loans are already prohibited, but now sale transaction, gift transaction, any transaction, if you receive 2 lakh and go to a hospital, pay bill of 2 lakh in cash, hospital will have penalty of 100%. Okay. So 269 ST orally I have covered, 100% penalty will be applicable. 269 SU, if your turnover in the last year was more than 50 crore rupees, then it is your duty to provide facility to customers that they can pay you through Bheem UPI, QR code, RuPay debit card, etc. If your turnover was more than 50 crore, it's your facility that to be provided. How to pay, choice of customer. He can pay in cash, check, credit, debit card, what else. Already you are providing, that is okay. But you have to provide extra facility. If the customer wants to pay through these modes, customer should be able to pay. And if you don't provide, 5,000 rupees per day penalty will get attracted. But if it's a B2B transaction and 95% or more is a non-cash mode, for example, manufacturer selling goods to wholesaler. So it is not a customer based thing. We want to apply these things for consumer based things like malls, retail outlets, cinema halls, where consumers are coming and using it. If it's a B2B transaction, then in that case, this section is not applicable, provided minimum 95% dealings take place in non-cash mode. Statement of financial transaction or reportable account. This also I will discuss here only. Certain assessees have to give certain information up to 31st May. SFT information. From 1st June, penalty will be 500 rupees per day. If you get a notice, it will still be 500, and after expiry of notice, it will become 1000 rupees per day. So non-furnishing or SFT will attract this penalty. If you give willful wrong information in SFT, willful wrong information, then 50,000 penalty will get attracted. A non-resident investment fund has to inform the IT department about activities in India. Otherwise, 5 lakh penalty will get attracted. If you are, this also of miscellaneous provisions I am completing here. There are few sections of miscellaneous like 269 ST, 269 SU I completed here, 285A I am completing, 285BA SFT I discussed. Certain assessees have to furnish certain information to the department up to 31st May. So 285A, an Indian concern having foreign ownership, Vodafone case, Indian concern having foreign ownership has to inform about change in ownership and any other transaction, and failure will be for change in ownership 2% of the transaction amount, for other cases 5 lakh. 271 GB is a penalty for uniform transfer pricing documentation, where you have to submit your country by country report. If you remember, there were 3 scales of penalty: 5,000 per day, 15,000 per day and 50,000 rupees per day. So let us do uniform transfer pricing documentation, then we will revise this particular part. If you file your TDS and TCS return late, there is minimum penalty of 10,000, maximum 1 lakh. Late filing of TDS TCS return, minimum 10,000, maximum 1 lakh. But if the delay is up to 1 year, no penalty. So till 1 year, no penalty. This penalty will come only after 1 year. But from the very first day, there will be fees under 234E, which will be attracted at 200 rupees per day, and this fees shall not exceed the TDS amount. This question also will come again and again in MCQs. Return file date, penalty will come after 1 year. Fees will be 200, 200, 200, 200, 200, but maximum restricted to the amount of TDS. Any kind of foreign remittances, inform 15 CA, CA report in form 15 CB, failure will attract 1 lakh rupees flat penalty. Any wrong information given by any CA, merchant banker or valuer, 10,000 per default on the CA, merchant banker and valuer. Any research association, university or company that has received a scientific research donation, then you have to file a statement with details of the donor, so that the donor gets the deduction under 35 or 80G. So just like in TDS, payer files TDS return and payee gets form 26A as credit, here also the receiver of the donation, the trust, college, association, university will file the statement, and the donor will be able to take his deduction under 35 or 80G. Penalty structure is same as TDS return delay. Minimum 10,000, maximum 1 lakh. 234G fees will be 200 rupees per day, but maximum to the extent of the amount in default. Just like here, maximum to the extent of TDS amount, here also it will be maximum to the extent of amount in default. Every time you get summons or these notices, or you don't sign any statement, or you don't reply to special audit notice, 10,000 rupees per default penalty. In all these cases, we also studied 10,000 rupees best judgment assessment also will get attracted. There are these few provisions where 200 rupees per day penalty is attracted. So if time permits, you read, otherwise you can ignore. Door-to-door survey, power to collect information. If you don't comply, fill up that form 45D, then 1,000 rupees per default will get attracted. Door-to-door survey non-compliance, 1,000 rupees per default. If you fail to comply with the PAN 10 regulation, not applied, not quoted, wrong quoted to PAN, 10,000 rupees per default will get attracted for violation of PAN 10 or Aadhaar related provision. CIT has the power to grant waiver under subsection 1, penalty for underreported income, which reasonable cause facility is not available, and under subsection 4, all other cases will come. Books not maintained, audit not done. Here you can take reasonable cause also, and if that is also not working, then you can go to CIT also. But what are the conditions? Like always, true and full disclosure, cooperate in inquiries, pay tax and interest if there is genuine hardship, true and full disclosure, cooperate, pay tax, genuine hardship. The conditions will always be same. Differences, here it is underreported income, here it is other penalty. If the underreported income is more than rupees 5 lakh, if the underreported income is more than rupees 5 lakh, then you will have to take CCIT approval, then only it will be allowed. And here if the penalty is more than 1 lakh, so here the income amount 5 lakh is applicable, here the penalty amount more than 1 lakh is applicable, then CCIT approval. This is once in a lifetime opportunity. Subsection 1 is under reporting, so you can take only once in a lifetime, but this can happen again and again. Books not maintained can happen again and again, so you can do this multiple times, and CIT has to pass the order within 12 months from the end of the month of application. This is the time limit to pass the order, and both these will fall in the list of non-appealable orders. Both these provisions fall in the list of non-appealable orders. Any case which is rejected by ITSC can also be requested. You can request, sir, please at least don't levy penalty on me, and this also they will pass the order within the time limit. Whenever they want to levy any penalty, they will always have to give a show cause notice. For show cause notice, there is no time limit, and this can also be done in a faceless mode. They will bring up a scheme for this, and finally the penalty order will be passed. In case of ITAT, the time limit will be expiry of financial year in which proceedings complete, that means ITAT order passed, or 6 months from the end of the month in which copy is received, whichever is later. In case of CIT appeals, expiry of financial year or 1 year from the end of the year. This is 6 months from the end of the month, this is 1 year from the end of the year, this is whichever is later. If you take some examples, you will come to know that this is always going to be the later of the two, the little defect in the enactment out here. If it was a case which got over at CIT in revision, then within 6 months from the end of the month in which the revision order was passed by the CIT, in all other cases, AO case, High Court case, Supreme Court case, expiry of financial year in which proceedings got completed, or 6 months from the end of the month in which show cause notice was issued, whichever is later, within this much time, the penalty order has to be passed. And if there is any time lost, then in that case, extension will be granted. In the main textbook, I have a penalty and prosecution chart. Section crime penalty, section crime number of years of jail. To save yourself from the burden of missing any marks in MCQs, say our MCQs will cover everything anyways, but if you want to save yourself, I suggest that at least that penalty chart you should do from the main textbook. Well, that's the end of our chapter called penalties. Let's go ahead. Next chapter that we will be having is our chapter called miscellaneous provisions. This is not at all important, so I will not consume lot of time on this. Rather, I will use the time saved to do TDS in today's episode itself, so that once TDS chunk is done, then as you are aware, rest part of volume 2 is anyways very small. So if we are able to complete TDS, that means in the next episode not just volume 2 will get over, but maybe volume 3 also can start, and in the next 2-3 episodes we will be able to complete this also. So 269 ST already I discussed that if you are accepting 2 lakh rupees or more from a person in a day, single transaction or one occasion or event from a person, then 100% penalty will get attracted, because 2 lakh rupees in cash we don't want you to accept, and exceptions will be received by government of bank, transaction already covered, any other notified transaction. Certain transfers to be void. During pending proceeding, if you have transferred any asset, then that transfer will be treated as void and we can recover money. And in fact, for that wrong entry part also, where you do accommodation entries and you have paid, we can recover that penalty also. If the penalty imposed is more than 2 crore, then we can recover that money also. But this transfer to be void will get attracted only if asset is more than 10,000, tax is more than 5,000, and it is one of the selected asset not forming a part of your stock in trade. The cases where this section will not apply, adequate consideration, AO's approval. Whenever you have any asset and we fear that you will sell your asset, then the AO can do something called provisional attachment. Before order, he will take away your asset. Validity will be 6 months, or it can be extended up to 2 years from the end of the 2 years from the date of provisional order, or 60 days from the assessment order, whichever is later. But only your assets which are of public use can be taken over. Any personal membership rights or etc. cannot be taken over, is what was held by Supreme Court in the case of Ahmedabad Stock Exchange. Instead of giving your property, you can also give bank guarantee so that you can recover your asset, and of course, if you don't pay your tax later, then the bank guarantee will be invoked by the department. How will they serve you notice? Post or hand delivery or electronic notice, especially after faceless. This will be very important because the notice will come in your e-filing account and you will be communicated through a real-time notification on your SMS. When they might be using WhatsApp, also email notification will also be sent to you. So all notices has to be signed by hand except electronic form. So once the electronic form becomes permanent, then this section will be of no use. Whom to send notice? After partition of HUF, Karta. But if Karta is not present, all adult members. If one is also missed, it will be invalid. And what about firm? Dissolved firm will be deemed to be in existence. So any partner, because they are joint and severally liable. Any liaison office of non-resident should inform activities about the activities in India within 60 days from the end of the year to the income tax department. Indian concern who has foreign ownership should furnish information about change in ownership and any other transaction. Otherwise, we already saw in penalty 2% for not informing about change in ownership and 5 lakh rupees for other transaction. Any producer of film, cinematographic film, you can see the gentleman here, any payment more than 50,000 rupees during the production of the film, you have to furnish the detail within 30 days from end of the previous year or completion of assessment, completion of production of the film. Completion of assessment बोलने का इतना habit हो गया. 30 days from the end of previous year or 30 days from end of completion of film, whichever is earlier, otherwise there will be 100 rupees per day penalty. SOFT, certain assessees have to furnish certain information like banks, financial institution, companies, they have to furnish information up to 31st May. If you do a delay, then 500 per day. If you get a notice, then 500 per day. But if the notice expires, then 1000 per day, and willful long information 50,000. Now your Form 26AS will change and it will become your annual financial statement, where not just your taxes paid but other details. TDS, TCS was already there. Payment of taxes of advance tax, etc. was already there. But all other information, any demand that we have raised or refund that we have granted, that will come. Any information that we get from a foreign country about you, that will come. Any pending or completed proceeding, any other specified, this will cover everything. Everything. Any kind of information that we get from you. You purchase a car, we get information from RTO. You purchase any FD or anything, we get information. All your financial transactions, you purchase any insurance policy, medical policy, everything will be automatically inserted in the system, and your annual financial statement will basically show you that what is the thing, what are the things that we already know about you. It is better that you declare your income accordingly so that there is no problem. Uniform transfer pricing documentation, also a part of your chapter base erosion and profit shifting. So there is a multinational corporation which has parent entity in UK. It has got constituent entities everywhere, US, Dubai, Delhi, Mumbai, and for Indian reporting purposes, the Mumbai company is appointed. So that will be called the alternate reporting entity, and Delhi will not be the ARE. If there was only one company, by default that becomes the ARE. If there are two companies, then one of them will become the ARE, and the group has appointed Mumbai company. Every CE in India, Mumbai, Delhi both will inform whether I am the ARE. This Mumbai will inform I am not the ARE. This Delhi will inform, and only this failure will attract 5 lakh penalty, but this has to be done only if the parent entity is a non-resident. Parent entity is in India, then all responsibility handled by parent entity. From now onwards, only ARE is responsible. Starting May, both Mumbai, Delhi were responsible, but now only Mumbai company is responsible. They will have to submit the country by country report within 12 months from the end of the accounting. Now, what is CBC report? Country-wise details of turnover, profit before tax, taxes paid, issued capital, retained earnings, tangible assets, employees. Country by country detail you have to furnish about all these things. It will include master file, that is entire group information, local file, that is individual entity information. So where are our companies located and all that entire group information will come here. For the individual entity, who are the directors of the US company, who are the shareholders of the US company, all that will be in the local file, and country wise financial data has to be furnished. If you don't furnish this on time, this is the 271 GB penalty. Delay up to 1 month, 5,000 rupees per day, that's your monthly stipend. Beyond 1 month, 15,000 rupees per day monthly stipend of Big 4 employee, Big 4 article in the 3rd year. And after assessment order also, if you don't furnish, 50,000 per day, that will be your monthly salary after becoming CA. 50,000 rupees per day penalty. And whenever they ask for any extra information, you don't furnish that, that will also attract similar penalty. 5,000 per day, and after order 50,000 per day. This section will be applicable only if last year's group gross turnover, means US, UK, Delhi, Mumbai, Dubai, all total together more than 750 million euros. Only if last year this amount was crossed, then this year CBC report, that means uniform transfer pricing documentation, will be applicable. Otherwise you will have to maintain normal data document information like any other assessee. Can we publish information about the assessee in media? Yes, we saw this in search chapter also, if it is in public interest according to CBRT. If you want, you can appear through a registered valuer, but he can go only before ITAT or IT authority. High Court, Supreme Court, of course, not allowed, because valuation is a question of fact. If I don't want to go and argue my case, can I send someone on my behalf? Yes, you can send your relative, employee, accountant, where accountant means CA holding certificate of practice. What is meaning of accountant? CA holding certificate of practice. Lawyer, whom we send in courts also. Bank officer, anybody who has passed an exam recognized by CBRT or conducted by. Here, someone else will conduct exam, CBRT will only approve it. Here, CBRT itself will conduct exam. Any other notified person. These are the people who can represent you in income tax. Though CA is the most popular, but these are the people who can go. This accountant, CA holding certificate of practice, in income tax plays double role. He does certification work. It is this accountant who will do tax audit, certification of book profit 115JB, certification of adjusted total income 115JC, that foreign remittances form 15, CB trust audit, political party audit, wherever CA certificate was required. In 10AA it was, wherever it was required. It is not CA certificate. They say accountant as defined in explanation of section 288. Accountant as defined in the explanation of section 288. That means he does certification and representation. If you are related to the assessee, related party, then certification work will be prohibited. That means I cannot sign tax audit report of my wife, or my wife cannot sign tax audit report of me. But you can do representation. No problem. If you are CA with COP, you play double role in income tax, certification and representation. If you are related to the assessee, then you will not be allowed to express your opinion. That is prohibited in CA Act also. But you can continue to do this. So this will be allowed even if you are related, but this will not be allowed if you are related to the assessee. And how do you decide? Related party. For a company, any person prohibited to do certification, representation can continue. Any person who is disqualified to become statutory auditor, same body, corporate, officer or employee of the company, partner or employee of officer or employee, business relation, any person who or his relative are in this company or its holding or subsidiary or associate or subsidiary of holding, are director or key managerial person, whatever you have to study here, you have to study from Companies Act. This is not from income tax. If you are disqualified from being statutory auditor under Companies Act, you will be disqualified from becoming doing certification work under income tax. You can continue to do representation work. What is prohibited? Certification. In case of an individual, he himself or his relative. In case of HUF, member or relative. AOP, BOI, member or relative. Firm, partner or relative. In case of trust, author, the specified person. Author, founder, manager, trustee, substantial contributor. If founder is HUF, then again member or relative. Any other person, the person who is qualified to verify ROI. And for B to G, that means from year to year. For company, already in the statutory auditor disqualification, all these points are covered. But for B to G, officer or employee, partner or employee of officer or employee, person convicted of fraud and 10 years not expired, business relation, if you have any debt or guarantee or security more than 1 lakh in company, it is already covered under statutory auditor disqualification. But for other assessees, these people will be disqualified. Relative for the purpose of this section will be most obvious: spouse, your brother, sister of spouse, your lineal ascendant, descendant of spouse. Spouse of all these people from B to E, spouse of all these people, and lineal descendants of your brother or sister of yourself or your spouse. The meaning of relative in income from other sources is almost same, except that in IFOS this last point is not there. Nephew, niece is not covered. This is nephew, niece, descendant of brother, sister. Nephew, niece, or nephew, niece of your spouse. Your nephew, niece or nephew, niece of your spouse. They are not covered. But there they cover brother or sister of parents. Here they don't cover brother or sister of parents. There they cover brother or sister of parents. That's only this one difference. So don't get confused. Learn this and that independently. Here, this is the definition of relative. Income and tax has to be rounded off to nearest multiple of 10. Every time you make payment, they will give you a receipt. If you pay on behalf of someone else, then you can be indemnified. Remember that representative will never pay anything from his own pocket. Any kind of jail term, any kind of prosecution we have to do, only this magistrate, presidency or first class magistrate will do it. Any other court or authority or commissioner or AO is not having the power to give jail under income tax. If there is a clerical mistake like wrong time or wrong assessment here, then the return or notice will not be invalid. Will not be invalid means it will be treated as valid. If there is a clerical error, it will be treated as valid. Just a printing mistake, it will be treated as valid. But if there is a fundamental error like after the due date or not signed, then it's not a clerical error. This is a fundamental error. Then it will be invalid. So to put it simple, if there is clerical error, your return notice order will be treated as valid. But if there is fundamental error, it will be treated as invalid. And in case you get an invalid notice after the due date is fundamental error. So it is invalid. You can challenge the notice, but if you cooperate, if you reply to that notice, then you cannot challenge. If you cooperate or you reply, then you cannot challenge. But you can challenge before assessment. That means after you cooperate, but before order you find out, you can still challenge. But after order, you cannot challenge. Same presumptions about books of accounts, documents and assets. What belong to the assessee? Contents are true, sign, handwriting, attestation of the same person of whom it appears. We can have one authorization to conduct multiple search. It is not necessary that there will be separate authorization for every search. Any act done by officers in good faith to protect the interest of the government, you cannot file a case against them. You will be prohibited from filing a case against them. They have the power to condone delay wherever it is not specifically mentioned. For example, in appeals it was mentioned, but wherever it is not mentioned, they can grant you something called adjournment. You go to AO's office, tell him, sir, I am not ready, can I come 1 week afterwards? So he can grant you condonation. If they have granted you any approval, they can cancel also your approval wherever it is not specifically mentioned. If the new budget is not enacted, even COVID came, but budget came. In 2020, budget was announced, then lockdown was there. In 21, first wave had gone, second wave had not started, so budget came. And in 22, second wave, third wave, everything was, but now people have become so comfortable, बोला ठीक है, come, COVID come, कोई problem ही नहीं. So, the last budget will continue to apply. So, I am still waiting for a day when there is no budget. That 1 year will be so peaceful. Still in all the questions, I will have to change previous year assessment here. Then cost inflation index, they don't bring in budget, they can come up with it on a later date. So, capital gain questions, I will have to change. And then we are living in the era of auntie. She brings ordinance whenever she wants. Whenever she feels that she wants to change, she will change. But in case there is no budget, then last year's budget will continue to apply. CBDT can make rules. The act will tell you what to do. The rules will tell you how to do. Income tax rules. Rules will be made by CBDT. Act will be made by Parliament. Rules will be made by CBDT. This is main. This is subordinate. In case of any contradiction, the act will override the rules. The act will be treated as superior to the rules. That's our chapter, Miscellaneous Provisions. Let's go ahead. Next chapter that we will be starting, a big chapter. So whatever we are able to complete in today's episode, we will complete, and then remaining we will continue and complete tomorrow, whatever is remaining. Very big chapter, also an important chapter. You can expect any number of questions on this. It can be a full-fledged question also, it can be MCQ also, it can be case law also, anything. Whenever one person makes payment to another person, for the payer it is an expense and the payee it is income. The payer, the payee will have to pay tax on that income, and the payer is the source of that income. So this chapter requires, example I have given you, client making payment to a chartered accountant, then in that amount there will be deduction of tax. This does not mean that the payer will have profit. He will pay only 90,000. This does not mean it is his profit or the payee's loss. This 10,000 will be deposited to the government as advance tax of the payee because it was deducted from his payment. It is like X has paid full 1 lakh to Y, and from that 1 lakh, Y has paid 10,000 advance tax. So when you calculate income of Y, you have to take full 1 lakh. When you calculate expense of X, you have to calculate full 1 lakh. That is going to be the gross amount. TDS is only going to get deducted, and later the payee will get credit. All the responsibilities under TDS will be on the payer. Which responsibilities? Deducting TDS, remittance to the government, TDS return filing, every quarter it has to be done, and issuing a certificate. All the responsibilities will be on the payer, and failure will result in disallowance of expense, interest, penalty and prosecution. Don't forget, TDS is not a levy of tax. Whatever is your total income, tax will be calculated as per the rates. We have studied tax rate in introduction chapter. We have studied in firms chapter and company chapter for the respective assessees. The tax will be calculated as per that, or if special rate is applicable, old regime, new regime, tax calculation will be as per that, what we have already studied. This is only a deduction. Whatever will get deducted, whether 1 rupee or 1 crore rupee, you will be getting credit. It is only a deduction, and if not deducted, then you have to make direct payment. As supposingly the payer fails in deducting this and he gives you full 1 lakh, then why cannot tell the government, sir, I got full 1 lakh, so I will not pay tax? No. Then you have to show 1 lakh as income and pay tax from that pocket. You have to make direct payment. But if you are an employee of a startup and you give sweat equity shares, then such employees, the tax payment will not be done immediately. That tax payment has to be done within 14 days from expiry of 48 months from the end of the relevant assessment year, or sale of securities, or seizure of employment. whichever is earlier. Find out the 3 events. From the 3 events, find out the earliest event. From the earliest event within 14 days, that direct payment has to be made by the payee, the employee, to the government. That is the time. So for all other cases, you have to immediately declare income and make payment, but here we are postponing, and this same rule is applicable for payment of self-assessment tax. If there is any demand notice or if there is any TDS on salary, by chance employer himself is deducting, that deduction also will happen at this event. The tax payment should not be done or will not be done right now. Tax payment will be done later. TDS is deducted only on selected payments, interest, rent, royalty, commission, not on all the payments, and that also if it is taxable in India. If there is any income which is exempt, there will be no TDS. TDS will be deducted only if the monetary limit like professional fees 30,000 or rent 2,40,000 is exceeded, and the rate of TDS is given in every section 1%, 2%, 5%, 10%, 20%, except salary there is no rate. Whatever is the full tax at applicable rates has to be deducted, and payment to non-resident full tax. These two sections including surcharge and cess. Surcharge and cess normally will not be included in the TDS rate, but if the payment is to a salaried employee and non-resident payee, because full tax has to be deducted, so surcharge and cess will also be deducted when payment of salary or payment to non-resident takes place. The payee has got only one duty: furnish PAN to the payer, and if you don't furnish PAN, then your TDS will be higher of the applicable, whatever is the applicable rate, 1 to 5 and whatever, or 20%. 20% or applicable rate, whichever is higher. 20% or applicable rate, whichever is higher, is going to be the rate of TDS if there is failure to furnish PAN. However, if a person is located in NJA, notified jurisdictional area, then it will be 30% plus surcharge plus HEC, or the applicable rate which is given, whichever is higher. For 192A, that is premature withdrawal from recognized provident fund, it will be maximum marginal rate. For 194O, e-commerce, it is going to be 5%, and there is a newly introduced section with effect from 1st July 2021, 194Q, about it's a payment for purchase of goods. So we will talk about it when we come to that provision. Here there will be 5%. So what is the normal rule? If payee does not, this is also an amendment, if payee does not furnish PAN, then section rate or 20%, whichever is higher, section or 20%, whichever is higher, but with 4 exceptions. In NJA it will not be 20, it will be 30%. In RPF it will be MMR. In 194O and 194Q, the new section, it will be 5% each. So section or 5%, whichever is higher. We also have another new section introduced with effect from 1st July 21 to target non-filers. Till now we were targeting those who don't furnish PAN, but now there are some payees who don't file return of income. They are getting income from the payer, but they are not showing that return, not filing the return. We want to target them. How will we target? When he will make payment to you, he will deduct higher TDS if you don't file return. If the payee is a non-filer, the payer will deduct higher TDS. If the payee does not furnish return of income of both the two immediately preceding previous years and 139(1) time limit has expired, and the aggregate TDS and TCS of both those years is 50,000 or more. Please pay attention. Our previous year is 21-22. So obviously 21-22 is going on, so we cannot check whether return is filed or not. We have to see the past 2 years. But 139(1) time limit has expired. Now, if you observe carefully, in 21-22, for 2021 the time limit has not expired. In April the time limit is going on, May, June, July time limit is going on when this section is created. 2021 time limit has not expired. So we will check the last 2 years, that is 18-19 and 19-20. Think about it. This is 18-19, this is 19-20, this is 20-21 and 21-22. When you are in this year, this time limit is still going on. It is these 2 time limits that have expired. So you have not filed return for both these years. Both, if you file any one also, then this section is not applicable. Not filed for both. Time limit has expired, of course, for both these years, 18-19 and 19-20. And in both years, your aggregate TDS and TCS was 50,000 or more. Then the TDS that is to be deducted in this year is going to be 5% or double the rate. So if the rate is 1, we will make it 2 or 5, whichever is higher. If the rate is 5%, then 10 or 5, whichever is higher. If the rate is 2%, then 4 or 5, whichever is higher. Double rate or 5%, whichever is higher. Double rate or 5%, whichever is higher. So what are the conditions to apply higher TDS on non-filers? Condition 1, not filed ROI. Condition 2, of both the years. Condition 3, 139(1) has to expire. So we will check these 2 years, 18, 19 and 19, 20. Condition 4, in both the years the TDS has to be 50 or more. So in this year TDS was 40, here it was 60. Then this section not applicable. Here it was 50 and 50 equal to is covered. Then applicable. And then what will be the TDS? 5% or double rate, whichever is higher. 5% or double rate, whichever is higher. However, this section of higher TDS shall not apply in the following cases. 1. If the payee is a non-resident with no permanent establishment in India, so may not be required to file ROI, not applicable. TDS under 192, already we are deducting full tax at applicable rates. TDS under 192A, the RPF section, casual winnings and horse races, already we have 30%. So, 194N again, already in 194N there is a cash withdrawal from bank account for non-filers. There is already another provision that if the assessee does not file return, then there will be higher TDS. So, for these sections 192, 192A, 194B, BB, LBC, 194N, this will not be applicable. And what about a case where the payee is such a big defaulter that this and this both sections are applicable? Means he has not furnished PAN and return, not furnished PAN and return. Then find out as per 206AA. What is the rule? Section or 5%, whichever is higher. As per 206AB, double or 5%, whichever is higher. In 206AA, it can be any one of these cases also. And then between these two, you choose whichever is higher. So, as per 206AA, whatever is your answer. As per 206AB, whatever is your answer. Between these two, whichever is higher, that will be your final answer. So, if the payee does not furnish PAN, section or 5%, whichever is higher. But there is a case where it will be 30%. There is a case where it will be MMR, RPF section, and there are two sections of 5%. And if the payee does not file return of 2 years, both the years, total TDS TCS in both the years is 50 or more. And 139(1) has expired, so we are skipping 1 year in between. We are checking 2 years before that. Then it will be section or double rate, 5% or double rate, double of the section or 5%, whichever is higher. And if both sections are applicable, then between these two, whichever is higher, that is going to become your TDS to be deducted. To save yourself from all this nonsense, simple suggestion: file return and furnish PAN to the payer. That much will save you. When should TDS be deducted? At the time of credit or payment? Whichever is earlier. TDS will be deducted at the time of credit or at the time of payment, out of the two, whichever is earlier. But in the following 9 cases, salary, lottery, horse races, NSS withdrawal, compulsory acquisition, receipt from insurance company, withdrawal from RPF, cash withdrawal from bank account, interest on interest, not the full section but only this part section. So, in these 8 cases, the full section TDS will come at the time of payment. In the section 194A, the rule is whichever is earlier. For FD interest, RD interest, whichever is earlier. But only interest on compensation and enhanced compensation, it will be at the time of payment. Normal rule is earlier, but only on this section it will be, only on this payment it will be, whichever is earlier. So, for 1 to 8, entire section falls in payment basis, but for 9, only a particular payment. And one more thing I would like to tell you, that there is one thing very special about this section. Cash withdrawal from bank. Whenever you make payment and you deduct TDS, it is income of the receiver, the full amount. So, client making payment to CA or tenant making payment to landlord, it is income of the payee. But in that cash withdrawal section, I am withdrawing my money from bank, but to curb cash, they are invoking TDS. So, the bank will just give me less money from my account and deposit that. This is withdrawal of my own income, and thus in that point 8, the TDS amount is not included in your taxable income. It is not, that transaction is not your income, just the deduction is happening and you will get credit. Credit is available, that money is not going anywhere. So, what is special about this point 8? This is the only section where TDS is not added in our income. And what is special about this 9? The only section where full section is not in payment basis. Only one transaction, interest on compensation, is on payment basis. TDS is deductible even on personal payment except if payment to contractor and professional fees. Only 2 places where personal payment will not attract TDS. Otherwise, TDS is applicable even on personal payment. The concept of equalization levy, very important concept. Part 1 and part 2, both we will discuss one by one. If you are a non-resident having no permanent establishment in India, one by one observe the condition. Non-resident, no PA in India, and you are providing specified service which covers online advertisement, digital space or any other notified. So, third condition, specified service. Total you are earning more than 1 lakh in a year. and you are providing this to someone in India, to a resident or a non-resident who has PE in India, to a PE of a non-resident or to a resident for the purpose of his business. So what are the conditions? Non-resident, no PE, specified service, more than 1 lakh, provided to someone in India for his business. Then you have to pay not income tax. Income tax cannot be applicable because residence and source not applicable. Non-resident hai and online transactions, so source cannot be established. But we will levy a nominal tax called equalization levy under the Finance Act of 2016. This is not under income tax. And because this is not income tax, 6% is all inclusive. There cannot be any SC, HEC over here. No SC, HEC. 6% is all inclusive. And the person who is making you this payment will be liable to deduct this. So 6% is your liability, all inclusive, no surcharge cess, and the person making this payment to you will be deducting that all inclusive payment, 6%. And then part 2, now we are widening the scope of equalization levy. So initial condition same, non-resident, no permanent establishment, and he owns, operates, manages a digital or electronic platform. We call him an e-commerce operator. Non-resident e-commerce operator. Digital or electronic facility or platform is nothing but an app or website. This non-resident is owner of app or website, and from this app or website he is selling goods or services or both. It can be his own goods. You know, I am selling goods from my own website or my own app, or I can be acting as an aggregator. For example, Uber is an aggregator. It is selling taxi services from taxi drivers. Uber itself is not providing the taxi. It is only an app. E-commerce operator who is selling goods or services of own or other person, and the amount is 2 crore or more. In 1 lakh it is greater than, but in 2 crore equal to is also covered. And we will not cover those which are already covered. So advertisement or digital space, they will not get covered. Everything else, all goods and services being sold online by a non-resident e-commerce operator who does not have permanent establishment in India. And to whom are we selling? We are selling it to a resident or a non-resident who is purchasing these goods from an Indian IP address. So non-resident has come to India, used internet address of India, Wi-Fi in India, and purchased any goods. So that will also get covered. Or non-resident with respect of advertisement services. Now advertisement, you will say, sir, is already covered here. But here it is covered only if the buyer is someone in India. Then only it is covered. If it is a non-resident who is buying, then it will not be covered. And this ad is purchased to show it to customers who will access the advertisements in India. Means a non-resident company is buying advertisement services from this e-commerce operator, and with this advertisement services it will be able to advertise its products to Indian customers online. The customers will access the ads online using Indian IP address. Then this new equalization levy will get attracted, and as per an amendment, if that portal is no sale of goods or services, only acceptance of offer or placing of purchase order, or only a payment aggregator like bill desk or any such company, supply of goods or services, they will also be included in this. Anything other than advertisement services which is covered here will be included here, and 2% equalization levy all inclusive, because it is not income tax, no surcharge HEC. 2% equalization levy all inclusive will be taken over here, all inclusive. In the first part, because it was a business purchase, definitely the payer will deduct 6%. In the second part, it is possible that I am buying goods from Amazon.com, not in .com. If it is in, then it will become Indian entity. Actually, Amazon has permanent establishment. So example will not work, but instead of taking any X limited, I will give you a little realistic example. Assume Amazon does not have a permanent establishment in India, and I am buying goods from the Amazon website for my personal consumption. Here it is business. Here it can be personal consumption also. I can go and buy this pen from Microsoft website for my personal consumption. Of course, Microsoft must be having office in India, but assume that they don't have PE, because the provision is applicable only if they don't have PE. If it is personal consumption, I will make full payment. I am not going to deduct. So it is their duty to pay from their own pocket. So an organization like Netflix, since the time this was announced, what they have done, subscription charges increased by 2%. So if they were getting 100, on that 100 rupees, they have to pay 2% tax in the form of equalization levy. So they have made that subscription 102, but they are idiots. Because now if the subscription charge is 102, the levy will apply on 102. So they should do in such a way that after paying 2%, they are left with 100. They should do it back calculation. If 100 is 98%, then 100% will be how much? That reverse working has to be done. If 6% or 2% levy is deducted, then there will be no income tax. Anyways, income tax is not going to be applicable. And two more amendments. If the ECO is only acting as a facilitator, that means the goods or services till now they were selling of other people and that was covered, but now they are only acting as a facilitator, only as an aggregator. So equalization levy will not get attracted, and any royalty or fees for technical services which is taxable under any DTAA, royalty or FTA is taxable under any DTAA, then again equalization levy will not be applicable. So these are two more amendments. Now one by one we have the various sections of TDS. First section, salary. Fast I will tell you. Employer will make payment to the employee. TDS will be applicable rates plus surcharge plus HEC. If there is no tax liability, then obviously there will be no TDS. Salary TDS can come only at the time of actual payment. So you have to calculate, every time the salary structure changes, because it is the applicable tax rates, the employee will keep on giving information about his other income, about his deduction, about his medical insurance contributions, life insurance contributions. You have to keep on changing, and after taking into account all the exemptions and everything, then only the total income, basically employer's duty to calculate total income of the employee, and on that calculate the tax. While taking the details under losses, the employer will take only house property loss. So if the employee is giving details about incomes, then he will take all the details, but if the employee is giving details about losses, then he will take only house property loss for the purpose of this working. If there is any other eligible loss, then the employee will have to show that in his return and claim that extra TDS as refund. And if there is any tax which is paid by employer on behalf of the employee, that's a direct tax, so no deduction, and for the employee it will not be taxable. And for startup employees it will be same. The TDS will not come now, the TDS will come at a later stage, 48 months from the expiry or seizure of employment or sale of securities, whichever is earlier, from there within 14 days. Premature withdrawal from RPF, if it is 50,000 or more, so equal to is covered, 3 sections, 50,000 year. I am not counting equalization levy part 2 where equal to 2 crore is covered. In TDS I am saying 3 sections, 50,000 year, 1 lakh in the insurance section and 50 lakh in the sale of property. So 10,000 TDS will get attracted only at the time of payment. If pen is not furnished, this is a case of MMR. TDS is applicable only if the withdrawal is taxable. The RPF maturity is exempt in the following cases. In fact, this provision inter students know it better because salary is taught in detail to them. If you withdraw after 5 years, then it is exempt. If it is exempt, then no TDS. If you transfer balance from one employer to other employer and complete 5 years, then it is exempt. Then no TDS. If your employer's business is stopping, then no TDS. Any other genuine reason, there will be no TDS. These are the cases where there will be no TDS because it is exempt. And if it is taxable, when you don't fall in any of these cases, then also TDS will come if it is 50,000. If it is only 40,000, it may be taxable, but there will be no TDS. Interest on securities, if time permits, you just read through it, not very important. TDS on dividend, any kind of dividend distributed, TDS will be attracted at 10%, but no TDS if the payee is an insurance company, no TDS if payee is resident individual and the dividend is up to 5,000 in a year, non-cash. So I am a shareholder of BPCL, I have got 160 shares, they gave 5 rupees dividend, so I got 800 rupees, they did not deduct TDS. Then in the same year they gave 63 rupees dividend, then it became about near about 9,000 or something, then this limit got exceeded, in that payment they deducted TDS. If it is resident individual, dividend is always paid directly in the account only, so it will be non-cash only, and if it is up to rupees 5,000, then there will be no TDS. If SPV dividend is paid to business trust, no TDS because it is exempt as we are aware, and any notified case government will release circular, no TDS. Interest other than securities, always remember ACHIJ, Achij, hot favorite sections, interest other than securities. And in all these sections, what is the definition of all person other than individual HUF whose turnover was less than this. That means individual HUF will get covered only if last year turnover in business exceeded 1 crore or profession exceeded 50 lakh. All persons other than individual HUF if last year's turnover in business exceeded 1 crore or in profession exceeded 50 lakh rupees. If you pay interest of more than 5,000 to a resident, but if the payer is bank, then we will apply 40,000 limit, and if the payer is bank and paying to a senior citizen, then it will be 50,000. So 3 limits: normal limit more than 5,000, bank paying to normal individuals 40,000, and bank paying to senior citizen then more than 50,000. TDS will get attracted at a rate of 10%. If A is paying 1 lakh and B is paying 96, they may settle their net amount at 4,000, but TDS will come on both amounts because the gross amount is exceeding the threshold. If a bank has adopted CBS, centralized data management, then the monetary limit will be total 40 or 50, whatever you are applying, you have to take total of all the branches. But a macro monitoring internal audit is neither credit nor payment, so there will be no TDS. Transaction between firm and partner, no TDS. Interest by cooperative society, excluding cooperative bank will deduct TDS. Cooperative bank will deduct TDS. Other societies, housing societies and all, paying to a society or its member. Any society paying to another society or member. Any society paying to society or member, no TDS. Cooperative bank paying to member, there will be TDS. Cooperative bank paying to cooperative society, there will be no TDS. That means, listen, first segregate the paired society into two: cooperative bank and others. Cooperative bank and others. If cooperative bank is paying to cooperative society, there will be no TDS. All other cases, there will be TDS. If any other cooperative society is paying to its member, no TDS. To a cooperative society, no TDS. And anybody else, there will be TDS. So member is covered only if the payer is not bank. If the payer is bank, then member will also suffer TDS. And wherever a cooperative society is not liable, say for these two cases, cooperative society is subject to the conditions not liable, but if their turnover last year has been more than 50 crore, their last year turnover has exceeded rupees 50 crore, then they will be liable to deduct tax. If their last year turnover has exceeded rupees 50 crore, then they will be liable for deduction of TDS. Any interest that you receive from motor accident claim tribunal up to 50,000 rupees, another threshold, no TDS. Interest on saving bank, there will be no TDS, thus TDS will come only on FD and RD. Interest on income tax refund, no TDS. SPV interest, no TDS because it is exempt. Any interest paid to bank or financial institution or any other notified transaction, no TDS. Winning from lottery, if you get more than 10,000, this time it is per payment, then there will be TDS 30% for resident payees and 30 plus SC plus HEC for non-resident payees. If the winning is in kind, then you will have to pay first 30% to the government, then your prize will get released. And if the lottery agent is forbidden to participate and the prize comes on an unsold ticket and you get extra commission, that extra commission ka TDS will come in the lottery commission section, but the rate of tax applicable will be 115BB 30%, and this TDS comes only at the time of payment. Similarly, horse races, if there is more than rupees 10,000 per payment, again then 30, or if non-resident then 30 plus SC plus HEC, this TDS also at the time of payment. Any payment to contractor, then it's a part of ACHIJ. So all persons other than individual HUF only if last year turnover in business exceeded 1 crore, in profession exceeded 50 lakh. If you are making single payment more than 30, aggregate more than 1 lakh, single more than 30, aggregate more than 1 lakh to a resident, then there will be TDS. What if the pay is individual HUF then 1%, pay is other than individual HUF then 2%. This is going to be the applicable rate of TDS. Pay individual HUF then 1%, pay other than individual HUF then 2%. What is the meaning of contractor? Contractor can be work done. Work done covers advertising, broadcasting, sponsorship, catering, transport excluding railways, any kind of work done. So goods will not be covered. Work done excluding employees and professionals because they have their own respective section. Any kind of, for example, courier agencies, C&F agents, any kind of work done, or any kind of labor supply activity like civil construction or security agency, any kind of work done or labor supply, then it will be covered in the definition of contractor. If the work done is not as per customer specification, that means you are selling goods, it's not 194C, it's not contractor. If it is as per customer specification and raw material you have purchased from any third party, that means again you are making something specific, but you are making and selling it, so it is goods, contractor not applicable. But if customer is providing you goods, customer or his relative, they are providing you goods, the raw material, That means you are charging only for labor. That will become a contractor payment and TDS will get attracted. Personal purpose by individual HUF, C and J, 2 sections. No TDS as we are aware. If the payee is transporter and has less than 10 goods and he furnishes a PAN and declaration that I have less than 10 goods carriages, less than 10 trucks, less than or equal to 10 trucks, then there will be no TDS. In 194C, TDS will come on the entire bill. So if I make labor charges of 1 lakh and say out of pocket expenses of 5,000, then TDS will come on entire bill of 1,05,000. Any out of pocket expenses charged will also attract TDS. Don't forget, TDS is not a levy of tax. If it gets deducted on 1 lakh, you get only that much credit. If it gets deducted on 1,05,000, you get full credit. TDS is not a levy, it's only a deduction. But if there is any GST added in the bill, so 1,05,000 plus GST, so the GST amount will not have TDS. As I already told you, courier agency, CNF agent, all that will get covered here only. If you pay an agent for 1 ticket, there will be no TDS. But if you charter the entire plane, take the entire asset in your control, then there will be TDS. If you take any cold storage, you pay any cold storage or refrigeration charges, then that will get covered here in 194C. It won't go in the rent section. And a very important Supreme Court judgment, Japan Airlines, Singapore Airlines, 2 assessees together fought in Supreme Court. If only asset is given, then it will be a case of rent, 194I. But if along with the asset multiple services are given, then it will be a case of payment to contractor, 194C will get attracted. Insurance commission more than 15,000, 5%, time permits read, otherwise ignore. Whenever you are getting money from insurance company, death cases it will be exempt, so no TDS. Maturity cases, if your premium is within the limit, then again exempt. If your premium is more than the limit, and the limits are same that we have already studied, up to 31st March 2012, 20% for all. From 1/4/2012, 10% for all. From 1/4/13, normal people will continue in 10% and handicapped will go in 15%. If that limit is crossed, or now new rule, if you pay more than 2,15,000 any of the policy years, even if it is within the limit of 20%, 10%, 5%, if the premium is more than 2,50,000 at any point of time, then in that case, it is going to be taxable. Only if it is taxable, then TDS will come. On the taxable amount, so from the amount that you are getting on maturity, you will subtract the premiums paid over the years. That amount will be the net taxable amount. Directly, the gross receipt will not be suffering TDS. If you are getting 5 lakh rupees and over the years you have paid 4,20,000, that's not crossing the monetary limit. Let's take over the years you have paid 3,80,000. So 1,20,000 is the net income that you are receiving. Then only that is going to be TDS 5%. And if the payment is 1 lakh or more, if the payment is less than 1 lakh, equal to is covered here. Na? In RPF and insurance section, equal to is covered. Okay. This TDS will come only at the time of payment, and that explanation of 1010D. If it's a death case, it will be fully exempt. Maturity case, if it is within the limit 20, 10 or 15%, then in that case, there is going to be no TDS because it will be exempt. But if you cross the limit, it is going to be taxable. Payment to foreign national sportsmen for game or sport articles advertisement, for sports association guaranteed amount, and for entertainer performances, same 3 images. What is their rate of tax? In case of non-resident, the rule is tax rate equal to TDS. Tax rate equal to TDS. So whatever is the rate of tax will also become the rate of TDS. For non-resident, rate of tax equal to rate of TDS. TDS on withdrawal from National Savings Scheme more than 2,500. You can ignore. This is not at all important. This is a useless section. 10% is prescribed. If you want, you read, otherwise you ignore. TDS on lottery ticket, lottery commission more than 15,000, 5% TDS will get attracted, and extra commission will also have TDS over here, though tax rate will be 30, but TDS will come in this section. Next, commission or brokerage. So part of Achij, therefore, all persons other than individual HUF. Individual HUF only if their last year turnover exceeded 1 crore in business, 50 lakh in profession. If it is more than 15,000, then 5% TDS will get attracted, but it will exclude any commission which is already covered in insurance commission and lottery commission. Any commission paid by MTNL, BSNL to their PCF franchisee, no TDS. RBI paying commission to banks for tax collection, no TDS. For the purpose of this section, commission means any payment for acting on my behalf, but excluding securities. So if you pay commission or brokerage on that security bill, no, buying and selling to your demat account company, to your stock broker, over there will be no TDS because it is excluded from the definition of commission for this section. It is brokerage as per dictionary, but for this section there will be no TDS. It has been excluded. So be careful. Any commission on securities, 194H not attractive. 194I again a part of ACHI. So same definition of payer. If it is more than 2,40,000 per co-owner. So if there are joint owners, you have to see which owner is getting how much. Whichever is crossing 2,40,000, only that payment will deduct TDS. So if we are paying one person 3 lakh, another person 1 lakh, total 4 lakh rent, only 3 lakh will suffer TDS. If we are paying 2 lakh each to both, then none of them will suffer TDS. For land, building, furniture, fittings, 10%. For plant, machinery, equipment, 2% is going to be the TDS that we will be deducting. If there is refundable deposit, it is not income, so no TDS. Non-refundable deposit is as good as advance rent paid, so there will be TDS. Any arrears of rent that you are paying now, that will also be included because it was never paid earlier. Warehousing charges will get covered here. Only cold storage charges are going in 194. See, warehousing is basically taking on rent only. Any payment to government, local authority or statutory corporation, no TDS. Focus only on this because anyways, as per section 196, any payment to government, local authority, RBI, anyways there is not going to be any TDS. Even if part of land or building is let out, there will be TDS. Whether the payee is owner or not owner, whether it is a lease or a sublease, subletting TDS will also come here only. And if there is any GST that we are adding in the rent, then there will be no TDS. If you take the asset full-fledged with fuel and everything, then it will go in 194C. But if you take only asset, without fuel, without driver, only asset, then it will go in 194I. If you take everything, fuel, driver, everything covered, all inclusive, then it is a case of 194C. Only asset will go in 194I, and REIT of course because the income is exempt, so no TDS. Next, if the rent is being paid by an individual HUF whose last year's turnover did not exceed the limit. I am a salaried employee with 10 crore salary and I can be paying 2-3 lakh rupees rent per month. But I will never deduct TDS here because as an individual I will never get covered. Here I am covered only if my business or profession turnover exceeds the threshold. And I am paying more than 50,000 per month or part, then there will be 5% TDS, but this is only on immovable property. Here land or building are only covered. Plant, machinery, equipment is not covered in 194 IB. So whenever there are high value rental transactions which are taken by salaried employees, then 194 IB will get attracted. If the rent is more than 50,000 per month, then 5% TDS will get deducted. At what time? You don't have to deduct every month. Last month of the year. So if the tenancy goes till March, then deduct full year's TDS from rent of March, full year TDS from last month. And supposingly you are vacating the tenancy in between, say in December you are vacating, then full year TDS from the rent of that last month, December. Last month you will deduct TDS, full year TDS. So pay in April, May, June, July, August, no TDS, no TDS, no TDS. When you pay for the last month, deduct full TDS from that last month. Year 10 is not required, and if 206 AA, PAN not furnished, then minimum 20%, or 206 AB where return is not filed, so double rate or 5% whichever is higher, and if both become applicable, then between these two whichever is higher, then maximum TDS will be rent of the last month. Joint development agreement, whenever a person surrenders his land or building to a developer so that developer can develop a big building and give him a portion that will result in capital gain. So that part of capital gain I am explaining now only. It is like you have sold your old asset and in return you have got the new property. Stamp duty value of the new property plus any amount in cash is going to be taken as selling consideration for the purpose of capital gain, and 10% TDS on the amount in money will get attracted. But the concept of joint development agreement applies only to individual HUF, and thus this TDS will come only for individual HUF. This takes us to the last section of ACHI 194J. Same definition, all assessees, but individual HUF only if last year's turnover exceeded 1 crore in business, 50 lakh in profession. If they pay more than 30,000 per annum, professional fees or fees for technical services, non-compete fees, director sitting fees, royalty, for each of them there is separate limit available. So 30,000 for professional, 30,000 for FTS, 30,000 for non-compete fees, 30,000 for director sitting fees. sorry, my bad, 30,000 for professional fees, 30,000 for FTS, 30,000 for royalty, 30,000 for non-compete fees. For each of them, separate limit of 30,000 is prescribed, but for director's sitting fees, there is no limit. In other words, if you pay professional fees of 25,000 and FTS of 25,000 to the same person, total is 50 but no TDS because they have separate 30-30 limit. This payment, this payment, this payment and this last payment royalty, separate limit. But if you pay director sitting fees 1 rupee also, there is no monetary limit prescribed. 1 rupee will also attract TDS. So for 4 payments, there is separate limit of 30,000. For the 5th payment, no limit is prescribed. And what will be the TDS? For operation of call center, 2%. For any kind of fees for technical service, 2%. Royalty only if it is related to films, then 2%. And all other cases. So professional fees will come here. Royalty other than films will come here. Non-compete fees will come here. Director sitting fees will come here. All that will come here. Personal payment by individual HUF, no TDS in C and J. Out of pocket expenses, if you give breakup, then out of pocket expenses, no TDS. I say audit fees, 1 lakh and 10,000 traveling expenses, then I will be having TDS only on 1 lakh. Indirect tax in the bill, if there is any GST added, audit fees 1 lakh, 10,000 out of pocket expenses plus GST. On GST, there will be no TDS. That's not there in any section. But out of pocket expenses in contractor section, there is TDS. In this section, there will be no TDS. And any payment made to umpire, coach, anchor, columnist, commentator, etc. they all fall in the definition of professional. So 194J will get attracted. Next, distribution of profit by mutual fund. So just like we have dividend, there also up to 5,000 to resident individual, there was no TDS. Here also, if you cross 5,000, 10% TDS will get attracted. Payment to contractor, commission and professional fees by an individual HUF not covered. There are 2 types of cases. Individual HUF whose turnover did not exceed the business profession limit will not be falling in the definition of payer. So they will come here just like 194I and IB. And second, in C and J, if you are making personal payment, only individual HUF can make personal payment. So in C and J, if you are making personal payment, then you will fall here. And you are making payment of more than 50 lakh rupees per annum. Say supposingly you are making payment for doing a plastic surgery. That's a personal payment. 1 crore rupees. A personal payment, that means you will never be covered in 194C or J. You will not deduct the doctor's TDS under 194J because it is personal payment. But it's a huge amount and thus 5% TDS will get attracted even on personal payment if the amount is more than 50 lakh rupees per annum. If the amount is more than 50 lakh rupees per annum. Plastic surgery ka example I have given also. So 194M, 5% TDS will get attracted, no 10 to be required and the nature of payment will be same as the other section. Whenever there is compulsory acquisition of your immovable property, then that means government will pay you compensation. If they pay more than 2,50,000, then they will deduct 10% TDS. This will come only at the time of payment, and on agricultural land there will be no TDS. Reason is, rural agricultural land is not a capital asset. So there cannot be any income arising. So no TDS. Urban agricultural land is a capital asset, but its compulsory acquisition is exempt under 1037. Compulsory acquisition of urban agricultural land is exempt, and thus for this reason there will be no TDS because this is exempt and this is not a capital asset only. Any other asset there is going to be TDS. Whenever you purchase, now this time it is not compulsory acquisition, it's a case of purchase of immovable property. Third and the last case where equal to will be covered. 50,000 in RPF, 1 lakh in insurance section and 50 lakh here. If you purchase, then the buyer who is making payment to the seller will deduct 1% TDS of the seller. Seller is not suffering the loss, he will get credit. TDS is never a loss, he will get credit. Here, urban agricultural land, there will be TDS because it is taxable. Only what is exempt? Compulsory acquisition is exempt. But rural agricultural land is not a capital asset only. So for rural, there will be no TDS. For rural, there will be no TDS in both sections. For urban, in compulsory acquisition, it is exempt, so no TDS. Here it is taxable, so there will be TDS. While checking the amount, all inclusive, so house charges, floor rise if it is a higher floor, car parking charges, club membership fees, advance maintenance, anything, that total if it is 50 lakh or more, then 1% TDS will get attracted, and here also 10 is not going to be required. Next, section 194N. Cash withdrawal. This is that section. From my own account, I am withdrawing cash. So this is not my income. But the government wants to curb this practice, prohibit this practice of withdrawal of cash. So they said that if you withdraw, they have kept a good threshold, a good monetary limit here. They have kept a proper monetary limit. If you withdraw more than rupees 1 crore from your bank account, cash withdrawal more than rupees 1 crore, then there will be 2% TDS on the entire amount. So if I withdraw 1 crore 50 lakhs, 2% TDS on 1 crore 50 lakhs on the entire amount. If I withdraw 2 crore, then 2% TDS on 2 crore. And 1 crore already threshold is used. And secondly, supposingly on 2 crore, 2% TDS is attracted also. In case 4 lakh rupees, that means you will get 1 crore 96. And you will get 4 lakh in the form of tax credit. If there is no liability, you will get refund. So you are not losing this money. But they want to stop this practice of withdrawal of cash. So any bank from where you are withdrawing 1 crore, then they will deduct 2% on the entire amount. Of course, in the points to be noted, you will be told that you can have multiple accounts in the same bank. So how will you avoid TDS? Now withdraw 90 lakh from one account, 90 lakh from the other account. We will be taking the aggregate. Goes without saying. Common sense we all have, but let's understand the rates and the monetary limits. Normal limit is more than 1 crore 2%. More than 1 crore 2%. But if you are a non-filer, so in the non-filer amendment, this section was excluded because already for non-filers, there is a provision. If you have not filed return for all the 3 last years and 139(1) has expired. So there it was only 2 years. Here it is 3 years. And the 139(1) time limit has expired before the previous year. Then there will be a little change. After 20 lakh, it will be 2%. And after 1 crore, it will be 5%. So normally the TDS is more than 1 crore 2%. More than 1 crore 2%. But here it will be more than 20 lakh than 2% on the entire amount, and more than 1 crore than 5% on the entire amount. This is how the TDS is going to get deducted if you are a non-filer for 3 years. And here that TDS limit of 50,000, remember total TDS should be 50,000, that is not incorporated. This TDS will come only at the time of payment. This is that only section where income will not be included in the income of the pay. Monetary limit will be on the aggregate withdrawals of all the accounts but that bank. So the best idea is open 2 accounts, one in HDFC, one in ICICI. Withdraw 90 lakh from those accounts. There cannot be sharing of database there. If both accounts are in ICICI, they have a common customer ID, then they will apply the total limit. But if they are different banks, there is no common data that can relate this. This section does not apply if the withdrawal is done by government, if a bank is withdrawing or any other notified person. So these cases, it will not be applicable. Next, TDS on e-commerce done by resident. For non-resident, we have equalization levy. Now, if an e-commerce operator, I have given you an example, if an e-commerce operator is paying any amount to e-commerce participant, for example, Ola is the operator, owner of the network, owner of the app, owner of the website is, and this is the participant, or maybe you can say Practo is a website where doctors are participants. So many apps and websites where CA professors are participants. If you are an e-commerce participant who is getting payment from a portal, then there will be TDS at 1%. Zomato will pay restaurant. Zomato is the portal, restaurant is the participant on the portal. Then there will be 1% TDS. What is e-commerce? Supply of goods or service through a digital network. So we are talking, examples are good enough. Ola, Zomato, Swiggy, Practo, all these examples. Services will also include technical and professional services as covered under 194J. So doctor getting payment from Practo will also get covered. Sometimes what happens is I may be paying directly, cash payment here. I can make the cash payment. Ola drivers ask, sir, cash or Ola money. I have made direct payment. That will also be included as payment made by the e-commerce operator to the e-commerce participant. But then one will wonder, sir, this taxi driver is so poor, if we deduct TDS, he will not have knowledge. No problem. If the payee is individual HUF, he furnishes PAN and Aadhaar, and the total paid up to is 5 lakh. The total amount paid in a year is up to rupees 5 lakh. Then no TDS. Then no TDS. Pay individual HUF, payment up to 5 lakh. So small cases, poor. Supposingly Zomato has delivered only one order from a restaurant in the entire year. So that restaurant, the payment will be up to 5 lakhs. It may be a firm or company, then there will be TDS. But if it is owned by a proprietor, individual HUF, furnishes PAN and Aadhaar, and the income is up to rupees 5 lakh, the total paid up to is rupees 5 lakh, then there will be no TDS. if this section is applied, so supposingly I am a doctor listed on Practo. Practo has made me payment. It is more than 5 lakh and it has already deducted TDS. Then again professional fees section cannot apply. If TDS is deducted under this section or any case covered in this section but TDS is not deducted because of this point. So this case is covered in this section. But if his total payment is up to 5 lakh, there will be no TDS. Any other section of TDS will not be applicable. If this section is applicable, TDS may be deducted or may not be deducted because of this facility. But if this section is applicable, then no other section of TDS is going to become applicable. Next, amendment newly introduced section with effect from AY 22-23 to make life easy for senior citizen. First of all, which senior citizen? Let's be clear about what do we mean by specified senior citizen. Resident. That means non-resident not covered. Not that general senior citizen which we always come across. Not that general senior citizen which is 60 years. This is 75 years or more. This is greater than and equal to. I have put the equal to sign here, but it is not visible because of the underline. So please be clear, it is 75 years or more at any time during the year, and he gets only pension income and interest income. And interest also not FD RD. Pension is coming, going in the saving account, then that saving account will generate interest. And he does not have any other income and he gives such declaration to the bank. So listen, there is a bank. It is paying an amount to a specified senior citizen. Who is the specified senior citizen? Resident. 75 years or above at any time during the previous year. Only pension income and interest from that account where pension is getting deposited. No other income and he is giving that declaration. So now what will happen? To make it simple for you, there are only two incomes, pension and interest. The bank will compute the tax as per applicable rates. It will give chapter 6A deduction, means it will compute NTTI, it will compute tax, rebate, surcharge, everything, and whatever is the full tax of this senior citizen, the bank will deduct that in the form of TDS. And if the bank has deducted the TDS, then he will not be required to file even his return of income. So a senior citizen, first of all, with senior, not our normal 60 years. Here it is a specified senior citizen. Resident, 75 years, only pension income and interest from that account where pension is deposited, no other income, and gives a declaration. Tell the bank that I don't have any other income. So bank will take the two incomes, apply the chapter 6A if available, rebate, etc. if available, calculate the tax. That tax will be deducted by the bank. So full tax is already deducted. So senior citizen does not have to pay also anything and does not have to file return of income. To make life easy for senior citizens, this provision was enacted. Next, section 194Q, newly introduced section with effect from 1st July 21. And this is that section where if pen is not furnished, then 5% will be applicable. Whenever a person is buying goods more than 50 lakh from a seller. So you are first time in TDS chapter, goods is being covered. Till that goods was never covered. You are purchasing goods more than 50 lakh. Then you will deduct 0.1% on the excess over 50 lakh. So 10 lakh no TDS, 20, 30, 40 no TDS. 50 lakh you purchase, no TDS. 55 lakh you purchase, 0.1% on 5 lakh. 60 lakh you purchase, 0.1% on 10 lakh. First 50 lakh no TDS, excess 0.1%. First 50 lakh no TDS, excess will be 0.1%. But this section will be applicable only if the turnover of the buyer was exceeding rupees 10 crore last year. So what are the two conditions? I am the buyer, you are the seller. I am buying goods from you. So I will make payment to you. Buyer will make payment to the seller. So buyer will deduct TDS of the seller. The turnover of the buyer last year should be more than 10 crore and this year he should be paying more than 50 lakh. Last year's turnover more than 10 crore, this year's payment more than 50 lakh. Then there will be 0.1% TDS on the excess over 50 lakh. First 50 lakh no TDS. It will always be a basic threshold, basic exemption. Only on the excess, not on the total. If it is 60 lakh, then 0.1% on 10 lakh, not on 60. But for that, my last year's turnover has to be more than 10 crore and current year's amount has to exceed 10 lakh. If this section will be applicable, then buyer will deduct TDS. If the buyer's turnover is more than 10 crore last year and current year he is purchasing more than 50 lakh, then buyer will deduct TDS. But this section will not be applicable if there is already TDS under any other section. In case, supposingly I am taking your services worth 5 crores contractor services worth 5 crores. And in that, goods worth 60 lakhs are also covered. So total is 5 crores 60 lakhs. But it's a case of 194C. The goods are consumables, out of pocket expenses. So in contractor section, I will be deducting TDS on the entire 5 crore 60 lakh. Then this section will not be applicable. So this section is not applicable if TDS is applicable under any section. Or if TCS is applicable. So there are certain goods on which TCS is applicable. Alcoholic liquor, Tendu leaves, licenses, motor car, foreign tour packages. If TCS is applicable, then also this section will not apply. But if the last section of TCS, last part of TCS, what was that? When a seller was selling goods to the buyer, along with the payment, he will collect tax. That's TCS, the last part of TCS. If that is applicable, then 194Q will be superior. That means, if we do 194Q versus last part of TCS, where seller has to collect, then 194Q is bigger and that TCS is smaller. This will override. But if we do 194Q versus any other section of TDS or TCS, then this will not be applicable and this will apply. Just to tell you what is the last part of TCS. If the turnover of the seller exceeded 10 crore last year, and this year he is selling goods exceeding 50 lakh, this 50 lakh is the common condition. Difference is, in TCS, his turnover has to be more than 10 crore last year, and in TDS, his turnover has to be more than 10 crore. So that means, listen, if only his turnover last year was more than 10 crore, his was not, then TCS will apply. Only his turnover was more than 10 crore last year, his was not, then only TDS will apply. If both had turnover exceeding 10 crore last year, then 194Q TDS will apply, TCS will not apply. If both had turnover exceeding 10 crore last year, this is common. Current year, sales for him or purchase for him. For seller, it will be sales. For buyer, it will be purchase. Current year, it has crossed 50 lakh. But we will first check last year's turnover. If only seller turnover exceeded 10 crore, then TCS. If only buyer turnover exceeded 10 crore, then TDS. If both exceeded, then TDS will come. That means this section is junior to other TDS sections, this first line, or other TCS like motor car or foreign tour package or alcoholic liquor or Tendu leaves or any of the licenses. It is junior to everything else, but it is senior to the last part, sale of goods exceeding 50 lakh. So, from 1st July 21, when both sections will operate together, 194Q and 206 ka last part, 206C last, you have to check. If both are applicable, then this will apply and the last part will not apply. Thus, with effect from this date, this section will override this TDS, the last one, 2061H. But all other sections of TDS and TCS will be superior. That means, listen, all sections of TDS and TCS. So, if in contractor section it is already covered, then it will not be covered here. They are bigger than 194Q. But 194Q is bigger than the last TCS, which is collected by seller on sales of more than 50 lakh. That's the chronology. Okay. So, finally, one last thing that you should note, I'll repeat what I have already told you. Once his turnover last year has exceeded 10 crore, then TDS will apply. If his turnover did not exceed, then he will collect TCS. Payment to non-resident, any amount which is taxable in India and not already covered, then we will deduct tax at applicable rates, including surcharge and HEC. Why are we including surcharge and HEC? Because it is non-resident, or the rate in DTAA, whichever is beneficial. Only if the income is taxable in India and not covered till now. If the income is not taxable, then you will grant a certificate and then there will be no TDS, and other points are very normal. Just to tell you that normal rates of tax you are expected to know, only DTAA rates will be given. In normal rates there will be SC, HEC, but in DTAA rates there will be no SC, HEC, and payer can approach the AO to seek clarification, foreign remittances. So you have to give this certificate. Now, with this, the main part of TDS is over. The main part of TDS is over. We have got very little left, honestly speaking, in the TDS part. Very little is left in the TDS and TCS. Very little is left. If we take another about 5-10 minutes, then the TDS TCS part of the chapter will get over. Let's continue for another about 5-7 minutes. TDS TCS will definitely get over grossing up principle. If you have given payment net of tax, all inclusive in hand, then by reverse calculation, we will gross up the amount. If you pay 1 lakh to a CA, then you have to do this. If 1 lakh is 90%, then 100 is how much? Gross up the amount, but TDS has to be complied with. No TDS if you are making payment. If the pay, that means if government is paying salary to employees, they will deduct TDS. We are making payment to government, RBI, local authority, mutual fund, anybody who has got exempt income, then there will be no TDS. Other general points. TDS is deducted but not deposited. Very important judgment of Supreme Court. In class and exam, practical life it will not help you, but in class and exam, very important. Will payee get credit? Yes, because responsibility is of the payer, and even if there is no TDS certificate, still payee will get credit. Supreme Court said if TDS is deducted, you get credit, whether deposited or no, or whether there is certificate or no. You can request for non-deduction of TDS under these sections: dividend and NSS withdrawal if you are a resident individual by furnishing form 15G, and if you are senior citizen, the payee senior citizen, then 15H you can furnish to the payer, there will be no TDS. Anybody other than firm or company can furnish for these sections: RPF, interest on securities, interest other than securities, insurance commission, payment by insurance company, rent and mutual fund profits. Again 15G, or if payee is senior citizen, then 15H, or you can submit for other sections form number 13 for low TDS or no TDS to the AO. So here directly you can submit to the payer, but here you have to get it from the AO that please do not deduct my TDS or please deduct low TDS. But for this, AO has to approve these sections, selected sections. You can directly do it without approval of the AO also. But if the payment is more than the basic exemption limit, your form will not be accepted. This restriction is not applicable to the senior citizens. Now that TDS is deducted, time to do the other duties. Deposit up to the 7th of the next month. So April ka 7th, May ka 7th, June 7th, July, like this. But the TDS of March has to be deposited by the 30th of April because of closing entries higher time. After deposit, return has to be filed. Return has to be filed quarterly. After the quarter, check the 31st. So June, you check 31st July. December quarter, 31st January. September quarter, 31st October. March quarter, 31st. I think there is a mistake here. No, it's not July. It's a printing mistake. Big mistake. I apologize. For March, April May there is no 31st. So it will be 31st May. 31st May. So 31st after the quarter is going to be the last date of filing your TDS return. 31st after the quarter will be last date for filing your TDS returns. 31st after the quarter. Okay, please make this correction. I apologize for this. But in cases of 194 IA, this is once in a lifetime, and IB is once in the year, last month, then you have to do payment cum return. You have to do them together within 30 days from the end of the month of the deduction. So you deduct on any date, say 15 July you deduct, then end of the month plus 30 days. Within that date, you have to make payment also, and you have to submit that online return also. Delay in furnishing TDS return will attract penalty of minimum 10,000, maximum 1 lakh. But that comes after 1 year. You will get 200 rupees fees. This we already saw, maximum equal to the TDS amount, and this is the penalty. Then you have to finally give TDS certificate to your payee. TDS certificate has to be given. For salary, there is one annual certificate, form 16 up to 31st May. For other sections, there is form 16A which will be given quarterly after the return due date next 15th. So after 31st July, 15th August. After 31st January, 15th February. After 31st October, 15th June. After 31st May, I hope you made the correction, 15th. After 31st October, 15th November, and after 31st May, 15th June. But for 194 IA and IB, the TDS certificate will be in form 16B and 16C. So 16 is for salary, 16A is for all other sections, IA will be 16B, IB will be 16C within 15 days from this due date of payment cum return, within 15 days from this due date. And here also there will be 100 rupees per day of default penalty. This was 200 rupees per day fees, and here it will be 100 rupees per day penalty. Now, if you have done the failure of the first two duties, that is TDS not deducted or deducted but not deposited. So penalty we have already seen, 100% of the TDS amount. Interest, will be calculated. Principal will be TDS amount. For non-deduction, the rate will be 1% per month or part. For non-payment, the rate will be 1.5% per month or part. So, rates are different. Obviously, non-payment is a bigger crime than non-deduction, and the time will be for non-deduction from when you were supposed to deduct, credit or payment, whichever it is earlier, till your actual deduction if you have made any future payment, or if you have not made any future payment, then when the payee declares his income, pays the tax, files return and gets a CA certificate that I have paid the tax. On that date, all the 4 events, the payee declares income, files return, pays the tax and gets a CA certificate. Then your non-deduction interest will stop, and non-deduction is very easy. The day you deduct, you are enjoying the money from that date till the date of payment, from deduction till the date of payment. So, principal will be TDS amount, rate will be different, and period of course will be different. And apart from that, you will also be liable for disallowance of expense. If you don't deduct only, it's a crime, and if you deduct but you don't pay, see, by the way, the payment due date is 7th of the next month. If you miss the 7th, you will be liable for interest. If you miss 7th of the next month, you will be liable for interest, but disallowance will come only after you miss the due date of return. So, not deducted, direct disallowance. Deducted, then we will check when was it deposited. Was it deposited up to due date of return filing? Then no problem. Otherwise, there will be disallowance. If the payee is resident, then 30%. If the payee is non-resident, then 100%. And in future, whenever this amount is paid to the government, that amount, 30% and 100%, whatever is disallowed today will be allowed in that future year. Whatever is disallowed today, that will be allowed in the future year. Well then, ladies and gentlemen, with this, the TDS part is over. So, what I will do is, we have already crossed the limit of 2 hours. So, what we will do is, TCS part, which is a very small part, and the remaining chapters, probably we will be able to complete our volume 2 in the, volume 2 we are 100% completing. Maybe we will be able to take up any small chapter from volume 3 also, like maybe salary I can revise, salary, house, property, both maybe. But today, for the time being, thank you for your patience for this extra time. TCS part we will continue and complete in the next episode. So, thank you for joining. Have a nice time. Have a good night and happy studying.